In the 1870s, the CEO of a railroad company decided to steal the most valuable asset he owned, the shares of his own company. This was history's first major recorded insider trading scandal. At the center of the game was one of America's most important railroad lines, the Erie Railway. The company was under the control of ruthless financiers Gould and Big Jim Fisk. Their rival was the giant of the era, Cornelius Vanderbilt. This was a wild period called the Railroad Wars, full of share accumulation and proxy fights. Gould and Fisk's plan was ingenious. On the New York Stock Exchange, they artificially bought and sold Erie shares among themselves at a high price, giving the market the signal that Erie was very valuable. But at the same time, by establishing a secret telegraph network, they instructed their brokers in other stock exchanges across the country to accumulate shares at a price much cheaper than their real value. Thus, they made an enormous profit by buying back the shares they sold at a high price in New York cheaply from other exchanges. This was a massive deception. When the scandal broke, the stock market suddenly crashed. Thousands of investors suffered losses. However, Gould and Fisk, using the legal loopholes of the era and through bribery and political connections, received almost no punishment. The Erie Scandal completely destroyed trust on Wall Street. The public began to believe that the stock market was a rigged casino for insiders. This event created critical pressure for laws to regulate the securities market in America, but it would take decades for this to happen. So what does this event teach us? Markets are only as strong as the ethics of their participants. Legal loopholes do not legitimize moral voids. True regulation is born not when a scandal breaks, but when it fails to prevent it.